2013 ended in peaceful and profitable fashion. The S&P 500 was up over 30%. Our client portfolios made healthy returns. And as we predicted back in November, momentum won the close in 2013. But 1 month later, things look very different. We've seen the return of volatility as risk assets are down, safe havens are up. And of course, the question is, why have we seen the return of volatility in 2014? So when volatility breaks out, we never think it's just one thing. Instead, we think many things contribute to volatility. And the first thing that we would point to is just the setup. Last year, we warned that markets were getting a bit complacent. That means that there were too many bulls entering the marketplace. We think that there needs to be a redistribution between bulls and bears here, and that's happening right now. Number two, there's a huge difference between the Federal Reserve stance last year and this year. Last year, Ben Bernanke was there to support the marketplace with bond buying all year long. This year, the Federal Reserve has made it clear that they're reducing the pace of bond purchases. The third thing I'd point to is the emerging markets. And there's some problems in the emerging markets that are stemming from currency devaluation, lower growth rates, and higher rates of inflation. And to exacerbate that, recently we see some problems on the US side. So domestically, I think investors in the marketplace was counting on the US to be the bellwether of growth. And lately, we're seeing some very soggy data points come out of the US. Some of that's probably contributed by the very cold weather that we've had. Lastly, we have a debt ceiling to figure out here. By the end of the month, we need to get that resolved, and that's hanging over the market's head. Currently, our strategy is to reduce volatility in the portfolios. Luckily, we began to reduce volatility and ring the register back in January. We're continuing to look for up days in the market to take our volatility much more to a benchmark level. Now, it's very important for our clients to realize that volatility is scary, but for us, we think this is a very healthy thing. And the most important thing to remember is that we think this is going to set up a really good buying opportunity later in the year.